Hello everyone, back again with a new spreadsheet. So here we have this S&P 500 all stocks listed here in this spreadsheet from row number 2 Apple to all the way to last two stocks are with a zero weight because they are like gone, right? SVP and Signature Banks are gone, but generally these are all you can see around 498 stocks of the 500 S&P stocks here, and these are weighted by the market cap. So for example, if I expand this, so you will see that Apple is 7.5% today. Then you have this weight for, the Apple's weight in the S&P was 7.17% about 10-13 when we had this previous the S&P low. Then we have multiple other columns here, so I'll go over each of them one by one, but this whole spreadsheet is basically all the stocks. They're sorted by the market cap and current market cap, and also we have various milestone, the price of the various milestones, and based on that what's the change from that milestones to as of today. So those are all that's the value add here. But also what it has is from Bloomberg, the latest last couple of weeks to sometime from early to mid-April until now, what is the price target, what is the lowest price target in the Wall Street for these stocks, and what is the highest price target for those stocks in the Wall Street, and what is the average price target. These are important. And then it also shows that what is the price target timeline, so what range of those of these numbers when those analyst price targets were published. So that means that it is mostly, you can tell that those are very recent, like none of them are from earlier than like April. So then in some cases I also have the earning estimate for 2023, 2024, 2025, not for all of them but for some of them, and then 1 year revenue growth and 3 year revenue growth in the forward PE as well, considering that the earning estimates are for 23, 24, 25. What are the different PEs? So now what are the color codes, right? So let me go over that a little bit before I kind of jump into the details. So here let me just hide this because there are too many columns. Now you know that these are weight for this, so I'm gonna hide these two columns so that we have more space to work with. This is the green, means that anything which has so it's a color scale. So if anything has on October 13, when this price was S&P was lowest in the last couple of years, around 3,589, that was the intraday low. Since then, what was the market cap back then? So if Apple was 125 at the time, so Apple's market cap was, obviously has gone down. So weight in the S&P was 7.17%, whereas today is Apple's weight is 7.7% because it has almost reached that $173 dollar, right? So based on that, you could say that there's all this price breakdowns. If I expand this, so you can see the price breakdowns on 12/31. Which was like 2021 end of the year, where the S&P was really high for 4,800, and since then we had this downfall. Then what was on June 12, that was a low 36 made for many of the stocks. Then we have the 10/13 when we had the CPI data came in October, that caused all the stocks to go down, and because the bond price went down, and the bond yield went down for 10-year and 2-year. Given the currency situation at this time with the UK and everything was going on, all the dynamics, pretty difficult time, as well as the Chinese stocks were kind of taking nosedive because of the some of the comments that after the CCP Congress meet that happened in China back in October. Anyway, then we have this end of this year's price, and then we have this like 3.6. Why it is important? Because that's where this now this is my son's birthday. On the same day we have this year SVP crisis that happened. which is basically, like we found out, the public found out that there was this banking crisis in progress because of this unrealized losses as the banks borrowed money from the Fed at a low, at a and basically went long with the borrowed money, which is basically they borrowed at 1% to 2% interest rate. Now this unrealized that bond price has gone up so much down, so they bought those bonds at $100 par value. Right now the bonds are around $70 for this 10-year yield. So that would actually completely collapse there for many of those banks, their balance sheet, because the asset price went down so much for this bonds they bought for the 10-year and 1 year for their loaning purposes. So people, because of the asset price loss, their stock price, also a lot of these companies actually started to the hedge funds started to short these banks. That caused a deposit outflow, aggravated also by this, that you can get 4%, 5% return on the money market with no risk, where these banks on deposit was giving 1%. So altogether, actually, this banking crisis happened that collapsed a lot of different stocks, which are really dependent on the capitals from these banks. So the small caps, such as the biotech, the ARK investment, which is like the high risk assets, those and the small caps, those all collapse, and money started to flow in to the big caps, which has a high cash generation, very liquid, very high quick ratios. Those kind of stocks are very low quick ratio. Those kind of stocks basically are really like the capital started moving in. So QQQ, the money started flowing in there. So that was an important milestone. Y36 is important, and I'm kind of tracking here that which stocks actually made a come back or which went down from 36. We'll see this in this video, and then the price today, right? So these are basically different price points, and based on this we will calculate how we are seeing that the stock market is playing out during the last since 12/31 really 2021 till now, in the last 16 months or 17 months or so. So now let's see what other columns are here. So we want to see the performance since this end of year 2021 for all the stocks of this S&P 500. What is the performance since June's low? What is the performance since October 13 low, as we just talked about? The performance YTD 2023, performance since March 6 SVP's crisis, and the 1 to 4 weeks performance. So these are all basically, the color coding means that if the performance is less than 0, then it's yellow. If it is less than 5%, so basically your stock is down 5% or more, it's getting red color. And then that's a color, the kind of a color scale. So, and then if its performance is more than 5%, it starts to get a greenish tinge. And then basically more the higher the performance, greener this color is, lower the performance, more red the color would be. So this is the color code for these ones, right? For all these performance issues. And then we have this color coding for the price target. So here what it means is that 127 in the street for Apple, the latest price target, the lowest price target is 209 is the highest price target. If the current stock price is within the 3% plus minus 3% of this of this lowest price target, then I would say that it is positive, it is green, right? If it is within 6% of the lowest price target, then it's yellow. That's to color code here. Okay, for the highest it's green if it is 50%. So if the current stock price is so let's see which is it. So 300 is green for Tesla, right? 300 is your highest price target, and so right now the Tesla price is 169. So why it is green? Because there is around $131 to be made if it actually meets the highest price target. Why still it is green? Because $131 is more than 50% gain. 50% gain would be for $169 current stock would be near $85. So that would take the stock to near $255 but it's the highest price target is 300, so it's above that 50% range, 50% gain. So there is a possibility. So the distribution is so high that in the highest price target is so high that there is a 50% lower. Current stock price is 50% lower than that. So that means that there is there possibly its current price is lower. So that's why it's green. So there is one more indication where it is. And then see the lowest price target for Tesla is 24. It's crazy. But if you look at the average is 191. So currently the stock is well below its average price target. But I don't care a lot about the average price target. I'm looking mostly at the low price target, and I take some indications of the high price target. If both are green, that means there's a very good possibility the stock is undervalued. So this is relying on the research that the analysts have done. Obviously, the analysts a lot of times are like they have their own agenda and they want to move the market based on certain things that they're out of their control. So they're and if they're right, then they're basically can see the future, so they're never right. However, that gives you the indication that where the median analyst, what is the basically the average price target, and where the you can in this all these numbers were based on very recent after the earning, most of the cases after the earning analyst estimates. So you have to rely that at some point some level of research has been done. So I just take it as a reference point rather than with some grain of salt, rather than actually totally relying on it. But this is a nice indicator to see that what the straight things the price should be, whereas if there's a huge dislocation somewhere, right? And then you can actually use this along with the other data to see that if the stock is in the uptrend, and as well as your chart, and make some decisions. So I'll go over that a couple of things that I did today based on this chart. So this is again, so the red here, that means that average price target, the current stock price is within the 3% of the current average price target. That means that given my the theory that okay, we are kind of at the top of what it could be in the next few months, given that we have the debt ceiling coming up, we have this economic conditions sort of like getting more credit crises happening. So the consensus in the street is that okay, we're going to have a recession. Maybe we are already in the recession for some part of the of the country. So given that, we should see the stock going down. So if the stock is already meeting the average price target for the year, that that probably means that you should be very careful. You should sell the stock. That's why it's red. So in some cases I have this this other indications as well, like the current and 3-year, 1-year earning estimates. These usually are like companies would try to meet those estimates, so they are usually accurate unless there's a huge dislocation, right? And in that respect, you can say that the multiple might be wrong. The market determines the multiple, but the earning estimates generally based on the average estimate, the companies would try to meet those estimates. Now, what kind of PE they're going to put on those estimates to get the stock price, that's a different story. That's why there is always market moves. So if we cannot meet the earning estimate, obviously stock will go down, right? Unless the guidance or there's some other story there. And if you are hugely beating the earning estimate or the guidance is really good, then the stock would go up. So here you can get an indication that what is the PE would be. So red means that PE is too high. Anything above 25 is reddish. Anything above 20 is yellowish, and then anything below 16 is kind of gets the green range. So this is the best color, 16. If it's higher than 16, which is the market PE, value market PE as the consensus is, which used to be like 16 years ago, but because of the low interest rate, the general PE is 19 for the S&P, and like 15, 16 you'll probably get in an instant when market gets bought. So, but let's say 16 is like really good valuation for most stocks, which if everything else in the same, then 16 is green, and 20 is kind of it getting expensive, and then anything above 25, anything above 30, I would say it's basically expensive, right? So that's very, very subjective. Every stock is different. Tesla at 30 may not be expensive, but like Google at 30 would be very expensive, or Apple. So that's kind of the how it goes. So now this is where we have is all these numbers. Now how do we choose a stock? Now I can see that, okay, this one, Meta, right? Meta, since the October low, its market cap, its weight in the S&P has gone up by 142%. However, since the high of 2021, it's still 30% down from the high, right? So it's not all good story, but so far it's a nice story. In the last 4 weeks, it has gone 7% up. Since the SVP crisis, you can see that 28% up. See, look at this for the SVP crisis. The first 10 stocks, except Tesla, everything went up. Why? Because people want to rely on this, except I guess the Berkshire Hathaway, because this is a different story. This is not the big tech, right? All the big techs, Apple, Microsoft, Google, Amazon, Nvidia, Meta, all of them went up above 20%. Why? Except Apple. Well, Apple went up 13% because it went up 33% YTD. That's why it didn't pick up that much after the SVP. But these were all beaten up stocks. So everybody went back to this because everybody realized that now the next thing is a credit crisis coming up. So the companies who are relying on the bank loans, they're not going to get that much of the bank loan, with the normal interest, so that they have to kind of go through, they have to kind of really prove their cash flow and all that stuff. So that means that why take a risk? Let's sell off all this, the Twilos and the DocuSigns and stuffs like that, and the Biogens and the bio industries, which are like, small caps. But with the capital incentive, which, where you need the loans, those are the companies who got really beaten up. Whereas this top tech stocks, which has a huge cash flow, all of them were up. Look at this Visa. It's not up. It's a top 10, but it's not up. Why? Since the SVP crisis, because it is not that. First of all, it was not that beaten up. It was a little bit, but not that much. But it was also it's not a the cash flow cow, right? What are the cash flow cows? Let's see here. Eli Lilly. It's up because it's a big pharma. It has a lot of cash in hand. Since the SVP crisis. So you'll find a lot of examples here. PepsiCo is a dividend player, so it's basically SVP crisis. A lot of those stocks which are like dividend players, they'll also go up because people want safety. 10% up Salesforce. Yes, this is also cash flow cow. So yeah, you can sort it out and you can see that the big 5-6 companies were the most one. AMD, another one which went up quite a bit, right? Because it's again fall in that big tech in a way. Okay, that's the SVP crisis story. The YTD performance 2020, you can see again, right? A lot of this. So Nvidia up 95% for the year, right? Obviously the AI story. Meta up 96%. Tesla up 37%, not bad, but Tesla is actually down 52% from its all-time high, or rather from when the S&P was all-time high. So Tesla is not overall, it's a mixed story here because of all these different things happening on Tesla. But generally in this year, if you look at the column Q, this thing looks really good, right? So except Tesla. United Healthcare is down 8% because last year it's all about go to safety. What is safety? Which is UNH is a safety, ELV is a safety because the healthcare stocks in the recession, in the bad cases, you get the dividend, and these guys always get their money, right? They're not going to be out of money because somebody is not paying the bill. They're going to get their bill from the medical because of the bankruptcy or whatever. So they are always their safest bets. So everybody went there. So park their money in UNH. UNH went almost all-time high last year. So that basically from there this year, because the money has shifted to the Apples and the QQQ, because people have seen that those are cheap stocks and those are beaten up stocks, and then as the crisis starts, then people want more cash flow specific companies, and they realize that there was a bad dislocation of the fund by moving away from the big tech. Big tech's earning was actually, except a couple of quarters in 2022, very reliable, meeting the estimates, beating the estimates, and revenue and the guidance is in line for EPS and the revenue in line in the guidance. So they actually moved the money back here, plus the AI story. So that happened, and that money from the UNH went there. So that's why UNH is down, and some of the other value stocks, the defensive stocks they call it, the XLVs, the XLPs were down, right? So that's one that the way to put it. And then let's see that where everything is green. So you'll find those everything is green in the small caps, especially small and mid caps. So for example, let's take a look at this one, Mondelez. What does Mondelez do? They are actually, you know, the beverage producers, right? So they're $77 right now. You can see that it's I don't have a price target for this one, unfortunately. Let's take a look at something else. General Electric, it's a, you know, it's a manufacturer of a lot of airplane parts, a lot of the defense industries parts, and so that, you know, with the Ukraine war going on, it was up, but the rest of the market was down, right? So 34% up since that. So it was a beaten down stock in 21. Nobody was looking at it in 2022, but then the Ukraine war started, and then all this, Raytheon and the Boeing and the folks who are, you know, relevant to the aerospace industry, to the defense industry, in the XLI, they went up, and the supplier for them, such as GE, also went up, right? And look at that, right? So this is all green here. Now, since the S&P crisis, it's still up. It's not that bad. It's last few weeks. It's all still up. And the price target is 90. So the price target, it's above the price target. So that's why it's not green. But generally, it's a good story here. Then I'll look into some of them, some others as well. The Boston Scientific, it's all green. Then we have, let's see which ones I have this price target here. Okay, this is a price target, so let's see which one, both of them green. Okay, this is a good one then. Freeport Macron, right? So this is the one that is okay, this is basically for the copper producer. Now the XLB is down, the material stocks are down because recession is coming, so everybody's selling off. Now this one actually still down 16%, so I'm not going to pick up this one, but you know, this is based on the lowest price target and the distance from the current price to the high price target. It is actually looks like a good buy based on the analyst estimates. Okay, so let me kind of dive down a little bit more. Which ones I have the price targets here? Okay, so now let's see. Okay, Pinnacle. No, I don't have anything on the Pinnacle. All right, so this is basically this whole spreadsheet. Okay, this is the one, Solar Edge, SDGE, is SCDG. This is one I sold some put today. Now this one is interesting because the earning has been hit and miss for the last 1 year, but last couple of quarters it's actually beating the estimates. I looked at the balance sheet; it looks pretty good. They're really actually increasing the cash flow. But if you look at the next few years estimate, right, it's consistently increasing the earnings. So 1 year earning growth is 71%. For 3 years earning growth is 149%. Revenue growth in 1 year is 32%. Great. And the 4P, it's an energy story. It's clean energy story. It has a huge like Europe, Germany, rest of the world, amongst US. So it's a very well diversified company across the geographical locations. And current PE is very high, right? Current PE is about 90. But look at the next 3 years PE. Because of the earning growth, the PE is going down from sort of like, it's actually 4P for 2023, but if you look at the 2022 or current trailing PE, it's in the 90s, right? So you're basically coming down from that high PE to this because of the high growth that it's actually offering. And look at this, right? So because of this clean energy, it has been 18% up since the October low. It has been up 5%, so it's actually making all-time high, right? So it's actually pretty high, it's one of the rare stocks which are up since the 2021 high, and despite all the stuffs went in. Now 10% down. This is a red one since the SVP crisis, right? Why? Because it is still considered a small industry. It's about $18 billion market cap though, but it's still smaller. And then everything which is risky, solar is sort of still risky in everybody's mind. They actually offloaded that. That's why it got hit. Now people realize that it was dislocation because the earning actually came up pretty good. Then look at the performance; it's 5% up in the last 1 week, 2% in the last. So it's not bad. I would not say it's a super stellar, but it's not bad. 288 is the lowest price target right now. The stock is at 296, and 445 is the high. So it's a high spread here. So 370 is right now the stock is 295.96. 370 is your. But if you look at the chart. Based on the chart, it seems to me that 260 to 370 is a good price range because it's a zigzag chart. 260 has a solid support. 270 could be the next stop. So I'd source a put here for the 270. Okay. Yep. So that's basically it. And then this is one of them. And then you can see some others. For example, Yeah, so so here let me show you one more thing here quickly. This is the median, right? So this is basically 95 percentile stock since all-time high is up 32.95% since October low 30. So this is the basically what it says is that of the 500 stocks, about 25 stocks, 95 percentile stock means about 25 stocks, which is mostly the big techs and the tech companies and some of the others and some small caps as well, are up 32.95% since October low. The 95 percentile stock 43%, right? Since June's low 46%. Then YTD, this the top stocks, the top 25 stocks in the S&P are up 28%. 75 percentile, that means that top 25 into 5, so 125 stockish, around 125 stocks in the S&P 500. Is that correct? 25 percentile, so 1/4, right? Yes, 125 stocks are up 2.80% since the all-time high. So it's still 125 stocks are up. Now, if I look at the worst percentile, right, like last 25, the bottom 25 stocks in the S&P 500 are up like 50% down, right? Still 50% down from the S&P all-time high, and like in the YTD, they're still 25% down. Whereas if you look at the median stock, this is the column, this row here, it's 12% down. So you take the highest, the good performing 25%, 50%, so it's 250 stocks, and you'll see that, and the rest of them, right? So you'll see that 12.89% is a return if you take that median stock, right? But average, if you look at the average is around same. So median and average around 12% down, whereas median and average is around just a flat over the year right now as the YTD. So that's how it is right now. So this is a chart where you can actually visualize this for the S&P 500. And this is interesting. So basically, this is an overall performance evaluation of the S&P 500 at the different milestones. The next one I would capture is when we have a upcoming low because of the debt ceiling crisis. The Republicans are saying that they're not going to increase the debt ceiling. You have to find some avenues to cut the cost. But if you look at the Biden's, the White House, their budget, there's not much you can cut. I mean, you can cut probably 1 billion, 2 billion, maybe 5 billion, but we're talking about, trillions. Like right now, the 33 trillion of the debt ceiling, and we're kind of approaching that by June, around first week of June apparently. And you cannot cut from the Social Security, cannot cut from the defense apparently. I mean, Republicans will not sign up for cutting for the defense, which is one only thing that you can really cut. Then you cannot cut from the from the healthcare stuff. You cannot. So there's not much to do, not much to cut from anywhere, right? So that means that you're not going to basically make a whole lot of dent. So what will happen in that case? You're basically two options. One is you're going to go to default. That means that the park employees, the federal governments will not be able to pay. There are a lot of issues going to happen with the bond interest repayments and stuffs like that. So that's going to cause a lot of volatility. Stocks going to go down. So I'm going to kind of capture that. It's probably going to be happening around end of this May, end of this month. And then once the debt ceiling sort of relief is behind us, then we're going to see that 0% interest hike in the next Fed meeting. So right now the Fed is around 5.25. So we're going to see all the stocks going to move up again around the mid-June until the July earning comes in, right? So June going up, maybe beating the 4300, but before that we're going to see a trough around 3800 again before this debt crisis sort of hits us, right? So I'm going to capture that as well in our next video, that what is the performance, like how does it how stocks did. So my anticipation would be that if you look at the market right now, the QQQ did well today, where many stocks actually went down. So if you look at last 1 week's performance, right, you see that the big caps are still doing pretty good as you go down the list here, right? So most of the stocks are kind of green the last 1 week, but in the bottom half, I bet that it didn't do very well. Why? Because turns out that they're not so bad as well. So, but the stock has been up lately because since the Apple earning, positive kind of vibe last 2 weeks as well. But if I have to bet, then the same thing we saw in the SVP crisis, that is going to continue as one of the other things that's happening right now. The banks are getting shorted, and the banks, as they're getting shorted, the deposit are going away, and then more of this Fed is going to come in. More of those banks are going to have to buy those toxic assets, whatever you call it. And that means that the Bank of America, the JP Morgan stocks will be under pressure. So they will be basically, the money will be flowing out from there, and they are going to be not sitting idle. They're probably going to go to those Nvidias and Apples and Microsofts and those stocks. So they're going to go up. Look at the Alphabet. In the it was $100 2 weeks ago. Now it's $117. Same thing with the Amazon, right? Amazon went up to 120 after the earning, went down to 100, 102, and now back in 112. So these people are parking money here. People will continue to do park money in the big cap stocks. Big cap is the PE is going to lift up again, and while that's happening, banks going to be under trouble. The capital incentive market, most like the XLI sort of things, will be in the trouble as people anticipate that the material cost is going to go down as recession is coming. XLB stuffs like that will be in trouble. The United Healthcare, most likely money is going to go back there. So right now the stock is a little bit higher, 487, but if it goes down a little bit further down, in the next couple of before the trough starts, because still money is moving into the QQQ stuff. But if the money goes down, goes a little bit of the stock market correction happens of 1 to 2%. If this goes back to 475, 470, it's a fantastic buy. It's probably going to be it's going to be bottoming out around that place. So that's a long video. So that's kind of where your market is, and hopefully it was helpful. So see you.